Hey guys, Brent Abernathy here. Hope everybody's having a great day. I want to get right to it today. Something that I've noticed from talking to a lot of you men and women over the last week or so that is coming up inside of homes with people is we've got agents running into clients who fill out a lead and obviously raise their hand and say, "Hey, I need help," or "I want more life insurance," or whatever it might be. And agents are getting to the house and the clients already have life insurance in place. And just being able to understand and maneuver and be able to talk about the coverage that they already have and explain to them how that's different than what you might be able to help them with the products that we deal with. It makes a big difference, and just understanding what you're looking at and being able to communicate that to the client. And I remember when I first started, I was hoping that when I got a lead and I called them and I booked an appointment, in my mind, I was thinking, God, I hope these people don't have life insurance. In my mind, I was thinking, well, that'll translate into an easy sale. They don't have life insurance. Boom, I'm going to go take care of it. Right. Well, as I got more experience and I realized, I really like it when they already have life insurance. Number one, because it proves that they're a buyer of life insurance. Okay. They've already bought, they'll buy again. Stats say that people will buy insurance 7 different times in their life. How many times do you want it to be from you? Basically is what it amounts to. But, so it was, I remember thinking, hey, I hope they don't have life insurance. But what I came to realize is what a lead is a lead is an opportunity. It basically gives you permission to have a life insurance discussion with somebody. And probably about 75 to 80% of the people that you end up sitting in front of already have life insurance, and you end up you can put them in a better policy or something that makes more sense, so they can take that money that they're already spending on policies and they can use it in products with you. Of course, as long as it benefits them, it's got to make sense. But we got to understand, as agents, we got to understand, what types of policies, these people that you'll run into out there, when you're running appointments. There's obviously there's term policies, there's whole life policies, there's universal life policies, a bunch of different types of policies. One thing that you'll run into a lot is, renewable term policies. Like if you see that somebody's got $50,000 worth of coverage, and it's a lot less expensive than maybe a 20-year $50,000 policy, with one of our carriers, it tells you there's something different about it. Okay. The renewable terms where sometimes they'll renew every 5 years. So they're super low in cost initially, but every 5 years they increase. And what happens over time is it ends up getting too expensive for the client to keep them. So the client ends up dropping them before they die. And now they've just made a donation to an insurance company. So you run into that a lot, either renewable terms every year or renewable terms every 5 years. Things like that. You run into accidental only policies, obviously a bunch, where somebody's got $100,000 worth of coverage for, $8 a month or something, and it only pays out, if they were to die of an accident, like they've got to die, a certain way, and it's got to be like in a car accident, and it's got to be like the 3rd Tuesday of the month, and they've got to be in a black car instead of a blue car. I mean, there's all kinds of different ways it has to happen for those policies to pay out. So you run into those types of things a lot. But the one I want to dig into more than anything today, that people have run into a lot this past week is universal life policy. Clients have a universal life policy in place. And just so you understand, there's term policies, there's universal life policies, and then there's whole life policies. All right. And obviously, term means they're renting the coverage for a certain amount of time, 15 years, 20 years, 30 years, whatever, right? They're renting that coverage for that amount of time. When that term is up, policy goes away. Okay. Whole life on the other end of the spectrum is the rates are locked in. It's guaranteed to be there when they die, no matter how they die. It's going to be there as long as they're paying their premiums. The rates are never going to go up. The coverage is never going to decrease, right? It's there, it's locked in, boom. So those are the two ends of the spectrum. Now, right in the middle is a universal life, and it's kind of like a hybrid between a term and a whole life, okay? And when you look at clients' policies, I would always suggest looking at clients' policies. When they say they already have coverage, tell them to go grab it so you can see what it is they have. And the easiest, don't ask them to go get it. Don't say, hey, can you go get that? Just say, okay, cool, go grab that. It'll speed the process up so we know what you can get qualified for a lot quicker. Like, clients want to make it quick, right? They don't want you pitching a tent in their house and being there for hours upon hours. So just say, hey, go grab that real quick. It'll speed this process up so I know what you've been qualified for in the past, right? And then just keep moving. But when you look at a policy, the product details page, it's usually the first or the second page of the policy. It'll say, you'll be able to see very easily like the schedule of benefits and things like that. And if something's locked in for 20 years and then the rates or the coverage or whatever change, well, that tells you that's a term policy, right? A 20-year term policy. And on the other end, if you see where everything's going to be the same, until the person's, 95, 100, 120, whatever, then that tells you it's a whole life and it's locked in. But what you'll see sometimes with the universal life, it'll say flexible premium universal life policy. That's the way that it's termed, is flexible premium universal life. Okay. And the reason why it's termed that way is because the agent who wrote that policy has the ability to set the payment up on however they want to. Okay. They can set it up where the client's paying the minimum amount each month to have the insurance. They can set it up on what's called the target premium, which will make the policy last a little bit longer, or they can have the client overfund it, basically to use the cash value and all that sort of stuff, that the interest on the cash value to grow money in the cash barrel. So, just understand, that's why it says flexible premium, okay, is because the agent can set the premium as low or as high as they want to. Now, a lot of agents with other companies aren't necessarily trained as well as our agents are, or understand the coverage as well as our agents do. And so what they'll do, they sell based on price. And so if you see flexible premium universal life, a lot of times those agents have sold that policy to the client saying this is a permanent policy, which a universal life policy is a permanent policy as long as it's set up properly. Okay, so they'll sell it to the client saying this is a permanent policy, but they will set the premium to the minimum premium. Okay, so that, because they're selling off a price, they're not selling off a value. We sell on value and really truly what's best for the client. And so they'll set it as a minimum price that they have to pay each month. Well, really what that boils down to is that means that universal life is really just, it says universal life, but it's really just a term policy. Okay. Because if you've got $100,000 20-year term policy, and if you've got a $100,000 flexible premium universal life policy that's set up on the minimum premium, it's the premiums for both of those are going to be very, very close. And it's basically just because it turns it into a term policy and it's coverage that they're actually just renting. Okay. So understand, I think it's important to understand how a universal life policy works so you can explain it to clients. Okay. And the way I always used to do it is I would have a sheet of paper in front of me, the back of the lead or whatever, and I would just draw two barrels. Okay. Clients really need to visualize how this stuff works. I mean, we can talk about it all we want, but they need to visualize how it works. And so I would draw two barrels, and this barrel on the left side of the page, I put a circle, and that's the insurance barrel. And then the barrel on the other side of the page is the cash barrel. Okay. And what happens with a universal life is, let's say the client, let's just say they're paying $200 a month for their universal life policy, and they've got $100,000 worth of coverage. So they're paying $200. Okay. And let's say the client is, and these are all hypotheticals, but let's say the client is, 55 years old. Okay. So $200 a month, $100,000 worth of coverage at age 55. Let's say it's $120 a month. That's what they have to pay to keep the insurance in place. Okay. So what happens is, when they pay out of that $200 a month, 120 of it will go into the insurance barrel. The other 80 will go into the cash barrel. Okay. Every single month. So this cash barrel over here will continue to build and grow cash. The problem is over time, as their age goes up, their cost of insurance goes up as well. So now let's say they're 60 years old, they're still paying the $200 a month, but now maybe their cost of insurance, instead of being 120, maybe it's $160 a month. So now 160 will go into the insurance barrel, and only 40 will go into the cash barrel. As they get older, again, let's say they're age 65. Well, now maybe all 200 of it's going into the insurance barrel, and nothing's going into the cash barrel, right? Well, when they're 70, the cost of insurance might be, say, $280 a month. Their $200 that they're paying every month is still going to the insurance. The difference is, at that point in time, the insurance company is pulling $80 every single month out of the cash barrel, putting it into the insurance barrel, because they've gotten older. Their cost of insurance is now $280 a month. And the problem with it, with those types of policies, is that they're not set up properly. This cash barrel keeps getting pulled from every single month, and all of a sudden it runs dry, and there's no cash over there to be pulled from. So what happens at that point is the client gets a letter, typically in the mail, from the insurance company, and it says, hey, you can keep this $100,000 worth of coverage in place. I know you've been paying $200 a month for it for 30 years, but now to keep it in place, it's going to be like $900 a month. And so the client ends up having to drop the policy. And that usually happens right around between age 78 and 82. Okay. Most of the time, if the policy hasn't been set up properly, that policy usually runs out. They get that notice from the insurance company, usually between the ages of 78 and 82. And I'll never forget, this was, 6 or 8 years ago. I was in a client's home over in Moss Point, Mississippi, and they were in their early 80s. Great couple, beautiful home overlooking the water, and they had a $200,000 policy, and they had been paying a couple $100 a month on the policy for a long time, and that's the policy that they had planned on having in place. If one of them died, to help take care of the mortgage and make sure the other one could stay in the home and all that stuff. Well, right before I got there, they got a notice from the insurance company saying, hey, you're going to have to pay $900 a month. And that's what happened is that time frame ran up. They didn't have any more cash to draw from. So I'll never forget sitting there, and the woman was in tears, because the fact of the matter is I could still help them. I could still get them insurance, right? But now they're 80, 81 years old. And really all that I could get them that was affordable to them was, I want to say it was like $12,500 worth of coverage, maybe 15 grand, something like that. And we did that, and it was coverage that was locked in. It was never going to change on them, all that stuff. But I'll never forget, how upset the lady was that they had been paying on this policy for so long, and they thought it was good until the day they died. And then now, because of their age and all that sort of stuff, we weren't able to get them that amount of coverage. And obviously, we were able to help them and put them in a better position than having nothing. But it was because of them not understanding how the policy works. So, and keep this in mind too. If you run into people that have those flexible premium universal life policies, a lot of times what will happen is, and you can call the insurance company, and that they have the policy with, and you can verify how much cash value they have built up in the policy at that point in time. Like if you catch it early enough, right, before that cash value really gets starting pulled into the insurance barrel, if you catch it early enough, what can happen from time to time, let's just say they've got $5,000 worth of cash value built up over here, right? Well, now you're explaining how these policies work if they're not set up properly. And the client might really see the value in, doing a whole life policy or doing a term with return of premium or whatever. But the point is, they might see the value in doing that, and they might want to get coverage with you and replace that policy that they already have. But if they've got like money built up in the cash barrel, the way it's going to work is when they cancel that policy, the insurance company is going to send them a check for however much money is in that cash barrel. So let's say they've got $5,000 in the cash barrel, and you're helping them get set up on $100 a month policy. Well, that's $1,200 a year that they would be paying on your policy. And so $4,800 would cover 4 years worth of the payments. So now you can talk to them about, hey, just so you understand too, this cash value that you're going to get from this policy, that's going to actually pay for the insurance for you for 4 full years. So it's almost like you've got 4 years worth of insurance for free. It's not going to change your budget at all, nothing, right? We're just going to take that cash value that you've got here, and we're going to apply it to something different that's never going to run out, that you understand how it works, that you see more value in, all that stuff. But so there's a lot of different things about it. But the big thing is understanding how those universal life policies work. Again, it says flexible premium universal life on the policy. And I've just seen it time and time and time again where clients have those policies and they're not set up properly. And as an agent, if we don't do our job, if we don't communicate it properly to them, we end up getting, leaving the home, and now that client's in that same policy, they think they're covered, and then 10 years later they're SOL and they get this notice from their current insurance company. So, and one other thing that happened too in one of the appointments this week with an agent is the clients, we weren't sure how, so I guess, how do you know if the policy, the universal life policy, was set up with the client paying the minimum amount or the target amount or whatever? And so what I did, I was talking to the agent inside the home. What I did was she was early 60s, and she had gotten this universal life policy in place when she was age 61. Okay. So what I did was I ran the same amount of coverage. It was $150,000 worth of coverage. I ran that price that she was paying, and I put in how much a 20-year term policy for somebody at age 61 would be. And they literally came up within a few dollars of each other, like within a couple dollars, I think. So that told me right then and there that universal life policy was set up on a minimum payments. because all you do is you take whatever age the client got that policy issued at, you run that through the term quoting tools, same amount of coverage, and you see how much the price was. If it's similar in price, that means it was funded on the minimum premium. Now, if they're paying on their existing universal life policy, if they're paying, $50, $60, $100 more than, say, what the term policy is when you run it on the quoting tool at the same age, that tells you that it's funded more properly. It's going to last them a lot longer. So that's something you'll run into a lot. And just understanding how to navigate that situation. And you can find out all this information without calling the insurance company or whatever. You can just use the age they got their existing policy at, run it through the numbers, the quoting tools, and see, because you know what types of policies we have, right? You know how they work. You know the benefits of them. If it's a 15-year term, the price is locked in for 15 years. If it's 30-year term, it's locked in for 30 years. The living benefits, all that stuff, right? So that's just the way to navigate that situation and be able to explain it to the client so the client can see. Because look, it doesn't make any sense. Insurance is federally regulated. So there's not going to be an insurance company out there anywhere that, say, has $100,000 policy, but yet the pricing for it is $100 difference if you run it at the same age, same health, all that sort of stuff. Like, it's not out there. It's federally regulated. So if you're comparing apples to apples with any of these types of policies in a home, the rates are going to be within a couple of dollars of each other for the most part. So when we have problems is when we're not comparing apples to apples. We're comparing apples to oranges, and we're trying to make a client understand the value in this one, but yet all they're thinking about is, well, heck, I've got this $100,000 worth of coverage here. I'm paying $40 a month. I don't understand why in the world I would do $100,000 worth of coverage and pay $120 a month, right? So if that's the case, is we're not comparing apples to apples. So we got to be able to explain that to the client. If you don't know, if you're not sure, that's why you call somebody, from inside the home. You call whoever it is that you work with, your mentor, somebody that's been around and seen all these different situations. That's why you can call the agent hotline number. That number is listed on any email that you get from the Gulf Coast group. But you call for help. But I just wanted to give some background. There's a lot of times we can really help people and save clients, from being put in that situation that client was put in with me, when they're at a certain age and they've already had health issues, and now they're stuck, they're SOL, and can't get anything more in place, because what we do makes a huge difference to people. And those of you that are out there who have had death claims, who have experienced it, who have run into some of these clients who don't understand what they have and they've gotten put in a bad situation, you understand what I'm talking about. Those of you guys that are new, and maybe you haven't run into some of these things, put yourself out there, get yourself in front of a bunch of people, and it will overwhelm you very quickly. The more people you put yourself in front of, how much of an impact we can make if we treat this like a profession, if we understand how to communicate these types of things to the clients. And as you're growing, as you're learning, run different situations, by people who have already been through those. That's the beauty of this business is there's always people around, that you can ask and that have seen pretty much everything that you could possibly run into. So, guys, don't embrace the fact when people already have insurance inside a house. Okay. Embrace that. A lot of the sales you're going to make, a lot of the families you're going to help are people who already have coverage, but it's not necessarily the best coverage for them. And we got to do our part in protecting that family and taking care of that family and communicating that to them, so they understand the value in what we do for them, but so they understand the value in the products that we work with. So I hope this helped. You guys have a great rest of the day, and don't hesitate to reach out to us if we can do anything to help. We'll talk to you guys soon. Bye-bye.